Let's get across to FIIG Securities and speak with Bill Keogh, who joins us from the Sydney camera. And Bill, hopefully you would have been listening to that as well. Do you think he answered that question, I guess, of whether there's enough flexibility in these global liquidity rules to account for some of the individual differences between countries? And particularly, of course, Mike Smith's question was regarding Australia.
Yeah, good morning, Brooke. Well, look, I think there are some complexities, and that's really with the Australian market and what is perceived to be liquid assets. And we all know that we've got a lack of government bonds here. So if we took a conservative view, if Australia took a conservative view and increased the ratios, well, then that is a real problem for Australia because there's not enough liquid stock. So we need to define what is going to be counted as liquid securities.
One of the other arguments brought up in that press conference was through a question by Jamie Dimon, which you might have heard me mention those comments as well. He was basically saying over-regulation of the banking system is basically contributing to the struggling recovery, I suppose, he's saying, in terms of availability of credit, and he said that feeds through to the jobless situation. Do you think there's an argument there?
Look, I think there is an argument, and unfortunately I did not hear his explanation, Brooke. But again, look, with our banking industry, we really need to look at the funding, how the banks are going to fund themselves. Now, if the credit markets are squeezed and there's a lack of credit, well, then there's issues again. So I suppose you would fall back to the old chestnut of looking at the retail market, and especially retail deposits, especially term deposits.
We should focus back on our own central bank as well. Lots of chatter about Ben Bernanke today, but still a lot of chatter about the Reserve Bank decision that's come to us this week. Do you think, from the signs that you're looking at, that we've got more rate hikes coming to us, and what, I guess, is the timing of those rate hikes?
Yeah, look, I think we explained our economy as being two speeds. It's probably more than two speeds. I think one of our, Mark Todd last week said there's probably a few more speeds. Look, the futures market has built in over the next 4 months a 50% chance of a 25 basis point rise. If you look at the yield curve, it is very flat from 6 months out to a year. I suggest that all the commentators, all the economists are looking at August when the latest CPI figures are released. But there's a lot of time between now and then, and we still have volatility in the underlying equity markets. So that there's quite a bit of time. I suggest that they'll stay on hold for a bit longer than that.
Oh, okay. What about news on the government guarantee? It's still covering deposits of up to $1 million. When are we expecting some kind of update on this, or when will the change come?
Yes, Brooke. Well, we actually did finally. We received some news last week. The regulators, being ASIC, the RBA and APRA, put a consultation paper out which was released by Treasury. And in that consultation paper they suggested that the $1 million would be narrowed in October when it's due to expire, down between 100,000 to 150,000 per depositor.
And what do you expect to be the impact of that change?
Well, again, it's got to be debated between the banks and what we call the third pillar. Third pillar being the building societies and credit unions. I suppose this is only a consultation paper, but in the meantime, we have to look at probably 3 points. Firstly, it was expected to bring the guarantee down in tranches. The reason they're probably not going to do that is because it'd cause a bit of confusion in the market. Also, bringing the guarantee down to 250,000 is in line with the other G10 countries. I think the next largest guarantee level is in the United States at 250,000. And the third point is that we've really got to look at, well, actually the third point is that with the 250,000, how much does that cover with the depositors? So APRA has looked at the result, looked at the total depositors. In volume, the guarantee covers about 40% of total depositors. That's deposits and term deposits, and it covers up to about 90% of actually depositors if the guarantee was brought down to 250,000.
And can I ask you one final question? There's been some concern, and we were running this story of from the regulator in the stockbroking sector about indirect brokers who can basically avoid much of the scrutiny by the ASX and ASIC. Is this a concern at all in the fixed income sector?
Yes, that's a very good question, Brooke. As we know, the stockbroking sector is covered, is regulated by, very heavily regulated by the ASX and ASIC. And in fact, each stockbroker that's a member of the ASX there'll be an on-site visit every year, and they'll scrutinise them through that way. And there is these brokers that indirect brokers that can deal in shares out not being a member of the ASX. With our asset class being fixed interest, obviously over the GFC there's been a lot of interest back into the fixed interest asset class, and it's not as regulated as the ASX. I mean, most of our securities are traded off the exchange, and therefore I'd suggest that that it's very important that both the investors of fixed interest and also the suppliers of fixed interest products do their due diligence. Now, this could be as simple as visiting a broker and asking the question, is your front office and back office separate? Who is looking after your risk compliance management? So it doesn't have to be, it doesn't have to take weeks, days and weeks. It can be done pretty simply, but I suggest it is prudent for investors and suppliers, being the banks.
Bill Keogh, thank you so much for today. We appreciate your time.
Okay, thank you, Brooke.
Bill Keogh.